Hello, welcome to Business Television India. I'm Shell Damania and you're watching Market Guru. And this is a special Market Guru where we celebrate a 2-year anniversary, and we've seen a lot of big market voices over the last few days. Adding to that list is another one big bull in our studio today. We've got Dipen Sheth. He's the head institutional research from HDFC Securities, and he'll be sharing his views on the markets and the economy with us. A very warm welcome to you, Mr. Sheth, to the show. Largely, when you're looking at the current scheme of things and the current atmosphere, how are you viewing the overall setup? The economy part, the market part, the foreign investor view towards India. When you accumulate all of this, what is your view on the overall setup at the moment?
So I must confess, so first of all, thanks for calling me for your celebrations. And I must confess that around the time of the budget, we were decidedly cautious as we could see headwinds in the form of political uncertainty building up as we approach election year, rising crude taking its toll on macros, and the impatience with the lack of earnings growth. And we've had 2 years of roughly flat earnings, at least at the index level, although obviously an average fails to represent what's happening in the broader market, but or even in the outliers. So that caution kind of played out in the months to follow after the budget, especially with the long-term capital gains thing thrown in and all of that. But we've seen a very strong pullback from there, much against the popular consensus. I think what is happening here is that there is renewed faith in the structural strength of the Indian macro story, despite the bad news or the turbulence that seems to be building up. And that structural strength has got nothing to do with whatever cyclical turnaround, headwinds that we might see in the form of a weaker currency and so on, rising oil prices and maybe inflation inching up a little bit. We would expect a 25 bits tightening at the current monetary policy round again. So I think what people are coming around to finally believing is that it doesn't matter who's in charge of running the country. It doesn't matter where oil prices or crude prices go, and it's wrong to say it doesn't matter, but right now it seems to matter less. The really big news that or the really big deal that is worth playing on is the fact that we are headed towards sustainably stronger growth and financialization of savings, which should keep P's high, even if earnings take a little bit of time to catch up.
But is the, when you're saying that internal money basically will keep coming in and driving the markets, is that going to be enough? Because you've seen that the US markets, they are heading towards more rate hikes probably towards as the year progresses. You spoke about our own macro situation. Currently, the crude prices are slightly higher than what we were. They've come off the highs over the last.
But it's still uncomfortably high.
Still uncomfortably high, and the currency also not helping much. Now, these were advantages that the government had towards the start of its tenure. Now, as we go towards the end of this tenure, do you think enough systemic changes have happened that the economy profile itself through this, not a very pleasant state, let's put it that way. It's not very bad, but it's not the most positive kind of state as well.
Right, exactly. So we benefited from cyclical tailwinds when this government got in, at least on the macro front. I kept on saying at that time that this is still not Achhe Din, this is Lucky Din.
Right.
Achhe Din will take a while to come. And by the time Lucky Din evaporated in the form of, now higher oil crude prices coming in, a global commodity cycle, headwinds to global trade in the form of trade wars and tariff and non-tariff barriers coming up and all of that, global tightening cycle playing out. So we might see across the board interest rate hikes, whether it's the US or the European Union or even Japan. Not to mention China, which is selectively tightening now. So all this Lucky Din may well go away, but the Achhe Din are probably now coming in.
So
and the evidence for the Achhe Din is in the form of very strong domestic formal savings and financialization of those savings. So even if there is a little bit of an EM sell-off globally, and if foreigners were to sell India, they will they will not only notice that India is the most resilient amongst the emerging market economies. What's more important is that the domestic inflows, so we are running at about $1 billion of inflows every month into Indian equities, purely in the form of stock SIPs. This disregards the more lumpy, inflows into equity that happen on lump sum basis. So I think somewhere in this, the truth that is coming out is that, okay, we can wait for earnings to come around again, but we are in a better country now, a better governed country, and frankly even the threat or the risk, the perceived risk that many of us have as to whether we will have a different government dispensation come the next elections, even that looks digestible now, and that, to my mind, that's very credible and long term and durable.
Right.
And it's much better to be in Achhe Din than Lucky Din. So we got excited with Lucky Din thinking it was Achhe Din, and now we are actually facing the prospects of Achhe Din.
Right. Another one major phenomena which has played out in the markets is that we have seen that the upward move of the Nifty has been, quite selective as far as stocks are concerned. Right. There are few stocks which are really, propelling the Nifty up. We've seen the heavyweights like Reliance, ITC do well, even TCS for that matter, helping. But the broader markets have not participated in the last couple of months. There has been an upward move, but again, very, very selective. So if you look at a BSE 500 list, you will find 20 stocks which have, given 15-20% kind of returns over the last 3-month period. What would your advice be to investors who went ahead and bought in the month of December, in the early part of January, and then after that we saw a downward move of the broader indices, the mid-cap and the small.
So if you look at the kind of movement that has happened, I completely agree with you that the movement has in stocks has been narrow.
Right.
And that maybe about 10 of the 50 Nifty stocks have outperformed the Nifty itself by a very broad margin and are actually driving up the Nifty. And we can take the names here. You can look at a Bajaj Finance, or you can look at a Reliance or a TCS, both of which are now more than $100 billion market cap as we speak. I think the important thing is now, I guess some of this will broaden out as we move forward, but what's important is in this entire movement, even if it is narrow, even if it is not broad-based, look at the fact that it's the quality names. So a Bajaj Finance, which has a decidedly better and stronger and more durable quality in its business, or a Reliance, or an ITC now, or a TCS. So TCS, we were forced to upgrade after remaining cautious for a while, and we were neutral for much of this uptick into that last 1 year or so of uptick. But we decided to upgrade it to a buy because there is no getting away from quality in this market. Right. So if you've bought in January and you're sitting on losses, or if you're afraid that the markets have not really, so indices have run up but you haven't made the kind of money, I would still say there is time to flip to quality.
Right. So in your recent report, you have outlined a few quality stocks for us. So let's discuss a few of them. On the consumer side, you've said that ITC is one of the stocks that you prefer.
Yes.
Now, in this current earnings season, we have seen that the volume growth numbers for quite a few of these FMCG/consumption related stocks has been very, very strong. Yesterday we saw numbers coming in from Dabur, 21% volume growth. These are kind of numbers which we've not seen before.
Right.
Even GCPL, Godrej Consumer Products, was on other, I suppose 14%. HUL again double-digit kind of volume growth. Yes. Why is it that firstly that you like ITC from this pack? Is it cheaper and hence, or do you like the pack overall and ITC is your top pick from that pack?
So the consumer sector is something that will probably never go out of fashion in an expanding population with increasing penetration, right, such as India's case is. That's the general purpose 40,000 foot comment, which is perhaps of no use to investors, right? What's more important is that many of these FMCG companies are reporting double-digit and higher than teen volume growth this time around, because remember that the April, May, June quarter last year actually saw the GST shock playing out in wholesale movement of goods. So I wouldn't read too much into an 18 or a 19 or a 17% volume growth. In fact, if you will look at what happened to Hindustan Unilever, it was that people were buying the rumor and they sold the news. Right. With a fabulous set of numbers, the stock actually corrected. I don't know where Dabur is today, but I must say we were more than impressed with the numbers, although the thesis on Dabur is a little different.
Okay.
So they are revamping distribution, and they are also coming off a tough base if you look at the year-on-year numbers. But the bigger deal in Dabur is the fact that they have now a fantastic product portfolio that straddles both urban, semi-urban and rural markets. And they have among the highest penetration or percentage of revenues in the rural market compared to most FMCG companies, and they are likely to gain out of this phenomenon of not just a good monsoon, but as we move forward into election season, rural incomes will be supportive. Mm-hmm. So I think the big picture on FMCG is, yes, they had a very good base to come off, a weak base to report good numbers from. Specifically on ITC, the argument is that for the last few years they've been at the receiving end of a brunt of, they've been taking the brunt of very harsh measures on taxation, indirect taxation, and also went through a stumble on the GST transition. Although, this is after many quarters we saw volume growth coming back.
Right.
I think our internal estimates of volume growth, they don't make a public disclosure, although are at about 1% or so, and that augurs very, very well for them. Remember that less than 15% of tobacco consumed in this country is consumed through cigarettes. Remember that gutka is going through a ban in many places. How effective the ban is a different thing. Yes, we are cognizant of the fact that the BD lobby is very, very strong and in fact has political support. Not to mention ownership. Right? But I think somewhere in this muddly movement forward, the argument for ITC, especially when valuations were 25x and south of 25x for a number of quarters, when the rest of the sector was quoting at, I think, an average of 35 or 40, or in some cases, even individual cases, even as high as 45x. Right. I think the value argument in ITC was too compelling. Okay. And as a Nifty stock, it was destined to move, shall I say. So the pullback from the 260 odd levels up to where we are today, that 15 odd % pull up is actually only catch up. And I think now the alpha could be generated meaningfully as the company may report volume growth. I think after lots of expectations and hopes and disappointments also, I would say, on their FMCG front or ex-cigarettes, their FMCG business, even that is in the throes of a multi-year I would say flowering, yes, most certainly. Right. So, and even today ITC is at least, I would say, 30 and in some cases 40-50% cheaper than its FMCG peers. Yes, you should value a sin industry company cheaper than its peers, but not this cheap. Right. For sure.
From the other stocks, if you look at your stocks like Nestle, for example, anything that you prefer, Marico?
So like I said, we are more than constructive on Dabur. We've been that way on Marico for a while. Right. So on both these stocks, I think so the caution that we are expressing, let's say, on Hindustan Unilever because of the big money that's already been made in that counter, I think that is not completely reflected in counters like Marico and Dabur, where we would be constructive for sure.
So you spoke about better valuation for ITC and hence you liking it. From there, let's move towards banking. And Kotak Mahindra Bank is also making it to your list. Now, within the private banking space, this is not a cheap bank. Valuation-wise.
It's probably the costliest.
It's probably the costliest.
Right.
So, why would you like this bank? Do you think that the asset quality fears, which have never been there for this bank, will completely stay away over the next 2-3 years? And also, do you think that the stock has more potential from current levels?
So, it's not that Kotak Bank doesn't have NPAs, first of all.
Right.
Why we think it deserves this, 4.5x kind of valuation net of subs is so the premium is worth paying for a conservative lender like Kotak, simply because of the character of lending that they do, simply because of the focus that they have in terms of ensuring that there is absolutely no stress building up which is over and above the bare minimum that would build up for any bank, right? Their fix on asset quality across cycles has been magnificent. And despite that, they continue to grow. And right now, they've stepped on the growth pedal. So the last couple of quarters, we've seen growth playing out. Now, obviously, from time to time, they keep on making these cautious noises on one or other segment of the market, and that's fine. At a blended level, the bank is going to grow. And it's going to grow faster than it has grown in the last couple of years, at least. They are right now adequately capitalized, more than adequately capitalized, I would say. They have a stream of subsidiaries, all of which are value accretive. I think if you really want to capture a financial conglomerate and put it in your portfolio for the next 10 years, it would be Kotak. Simply because of the quality of the management and the focus that they have on running the business in a very, very conservative manner.
Do you also think that a few of these subsidiaries, as they grow bigger and stronger, would be separately listed, and hence that?
So look at it this way. If you look at the asset management company, it has suddenly found its wings over the last couple of years, if you will see. So, I don't want to sound disparaging, but for a number of years, they were almost like an also-ran. And if you look at the way their AUMs have grown in the last 2 years, ahead of the rest of the industry, last 2 or 3 years, they were very good asset managers even prior to this. But it's just that they found their mojo in that business. Okay. If you look at their brokerage business, if you look at their insurance business, which is now slowly coming into its own, I think there's, and obviously their non-bank lending business, which is Kotak Prime. So all of that added up gives you the kind of financial conglomerate that very few companies are being able to give you today, with the kind of management quality, and I will never tire of saying this, which is so rock steady and clear in its focus, that I think 4.5 times book doesn't scare us at all. You may not make money from a 1 month perspective, but that's not why you buy Kotak.
Right. Fine. You've already outlined a multi-year kind of an approach towards Kotak. But, what we have seen as far as PSU banks are concerned over the last 3 months is a lot that the government has done. There are a few NCLT cases which have actually gone resolved as well. And the banks have received money and also reported it in this quarter's earnings. Recoveries also are slightly better, and not to mention that the valuations are not even comparable to private banks. They're much cheaper, a few of them even less than one-time book. Any from that space that you feel that valuations may actually see a catch-up and could be good over a year and a half kind of a perspective? So
it's tempting to look at some of the most battered public sector banks, the headline cases on blow-ups in asset quality, so Bank of India or an OBC and so on and so forth. What we figured out in this entire stress cycle as analysts is that except for the really stable names in the PSU space, and obviously SBI and BOB alone come to mind, despite the headline stress that they've been battling, despite the odd disastrous quarter also that they've reported, I think to my mind the rest of the PSU pack is actually a vulture's pick, if you will, on the asset quality revival story, and it's very difficult to find, I would say, a high confidence trade there. You may make a lot of money in some stressed out name, like let's say an Oriental Bank. But all these other banks outside of SBI and BOB are stressed to an extent where there are going to be capital calls on them if something doesn't happen soon. And to my mind, this NCLT process is taking a little longer than it should have or could have, and that's how India moves forward. We take 3 steps forward and then 2 steps back and then another 3 forward and 2 back. So the most vulnerable names are likely to be on the wrong side of the stress when these 2 steps backward happen. I would rather go with the BOBs and the SBIs here from the PSU pack. We've seen BOB now getting back into high growth. We've seen a massive cleanup playing out there, courtesy, I would say, the new CEO now, not so new CEO now, who is, so there was a little bit of heartburn last quarter, around the last quarter, when we got the sense and the vibes that he may not continue, but I think that is also now mostly taken care of, although there is no explicit confirmation of the same. Mr. Jayakumar has done more than fabulous duty there, and frankly he doesn't need a certificate from us in this matter. And if there is faith in a battered PSU bank turning around, there is continued faith in BOB. And obviously SBI being the largest name and slated to be obviously the largest beneficiary of NCLT resolutions, I would think SBI would be next in our pecking order there.
Right. You also picked out one stock from the IT space, is HCL Tech. This sector is the one which has outperformed many others from the start of the year till now. And at the same time, when you're looking at the first quarter earnings for most of these, there's commentary is positive, but none of them have really, the ones who give guidance, they've not increased it much. Right. So if you look at HCL Tech in particular, the guidance remains pretty much the same as what they'd given in the last financial year. Do you think that the kind of stock performance growth that we have seen over the last 6 months Is that possible to continue over the next 1 year? Maybe not at that pace, but is that possible for the overall sector and HCL Tech as well?
Right. So, I must confess that HCL Tech has actually underperformed the rest of its large cap peers. If you look at the way TCS has performed, or Infosys, for example,
right,
which is up some 40-45% from its lows at the time Sikka was making his exit. None of the IT majors, at least the large caps, have delivered stupendous earnings growth to that extent. So the big money has been made on the re-rating. A year and a half ago when we saw these stocks, there was no hope in hell that they would grow at double digit. Currency was against them, and their businesses were structurally threatened by an alleged combination of automation, artificial intelligence, cloud computing, and you name it. The digital transition, as it were. And many of them have actually responded magnificently to this challenge. And why we saw value at that point of time was that they were going for very low free cash flow yields. These are essentially 25% bare minimum ROIC businesses, even at the worst of times.
Right.
And they were spewing out cash, and they were going for free cash flow, or at least operating cash flow yields north of 5%. In some cases even higher.
Right.
So that was a value argument at that point of time. Since then, the P's have re-rated much more than the earnings. Even today, none of the frontline stocks is guiding for anything more than 10 or 11% growth in dollar terms. But now the currency is in their favor. And this entire thing about business evaporating away in the face of the digital threat is not really happening. In HCL Tech's case, I think specifically, its growth numbers have lagged the rest of the industry, or at least lagged expectations. If you will remember, they had, and they continue to have, a very strong IMS practice, so which stumbled over most of last year. I think much of that is now getting repaired, and if you look at their business mix now, I think so what has not worked for them is that their acquisitions have failed to fire.
Right.
So that might turn around. And the third thing is that increasingly in their business mix, the scope for platform or IP dominated business mix, which has richer margins, is likely to improve as we move forward. Deal wins, if you look at order flows and deal wins, they have improved, and in fact last quarter was one of their better quarters in a long time in this respect as well. Headline valuations right now are probably the cheapest for HCL Tech. I think if I'm not mistaken, it's going cheaper than Wipro right now, which has failed to deliver growth for a long time, which is not the case with HCL Tech. In fact, there is embedded promise of accelerated growth here on. So to that extent, we think that if there is a catch-up of sorts to be done, then you might make more money in HCL Tech than any of the frontline stocks. It's a bet that we'll stick our neck out for a while, and we'll see how it goes.
Right. Mr. Sheth, just one last question, because this sector, the auto sector, we cannot not discuss it. It's been doing very well for itself. Stocks have also been doing very well. But again, anybody who wants a piece of that pie has to pay a lot more money than, let's say 2 years ago. Are things looking expensive to you in the Marutis, Bajaj Autos, Heroes of the world? Is there anything that you prefer? How are you overall placed on this sector?
So, we've downgraded Maruti, and we are not too popular having done that. The big money we think has been made there. It's a fabulous business, with the kind of market share it has in India, with the kind of premiumization and the updrift in margins which has played out, the kind of cash richness that the company has now. But I think much of the money which could have been made over the last 3 or 4 years has been made in Maruti already. We do not have a low opinion of the quality of the business. It's just that the stock may not deliver the kind of returns that you might think, that you might want to make. Right. So the good news is all embedded in the price. It's baked in. On the other hand, some of the very very capable names in the sector have been battered lately, for reasons which we are struggling to fathom, quite frankly. So this entire thing about the new axle load classification and Ashok Leyland taking the hit, or this entire thing about Bajaj Auto lowering prices in the entry segment of bikes and dragging the stock prices of both Bajaj and Hero Moto also down into the dumps over the last month or so. I think both of these events are certainly opportunities. So the auto sector, as you know, has always worked with a very high disparity volatility in the kind of performance and, business performance and stock performance. And I think this is the time to look at genuinely good businesses which have got battered for no reason. Bajaj Auto reported fantastic numbers for June, and in fact they've increased prices.
Right.
So I don't think it's going to be one race downhill for pricing and gaining market share in the economy segment, as it were, in motorcycles. I think both Bajaj and Hero look very exciting from that perspective, although Bajaj has a richer mix which is skewed towards three-wheelers, exports, and even higher-end bikes compared to Hero Moto. So if you're looking for a slow and steady drift upwards, then you would buy Hero Moto. But if you're looking for serious alpha here on, I think a calculated risk can certainly be taken on Bajaj Auto. Remember, both businesses are working at anywhere between 50 to 70-75% ROIC, and valuations for both are sub 20.
Right.
And at least for Hero, I think in the economy segment, I think rural incomes will support volume growth there for sure for at least the next year and a half.
So largely, again, positive. So that's Mr. Dipen Sheth. He's the head of institutional research at HDFC Securities. Many thanks, Mr. Sheth, coming in and sharing so many stock views and ideas for our viewers. Thank you so much for watching.